On September 30th, 5 years of American inflation history gets rewritten. Not revised because of new data, rewritten because the government agency that calculates the Fed's favorite inflation number is changing the math. And when the new math comes out, inflation since 2021 will officially have been lower than what they told you. Your grocery bill isn't changing, your rent isn't changing, but the official record of what you live through, that's changing. By the end of this video, you'll understand exactly what they're changing, why they say they're changing it, and the part of this story that actually matters for your money. And stick around, because there's one detail buried in this announcement, one specific category they're recalculating that tells you everything about why this is happening now, of all moments. Most people covering this haven't even noticed it. Real quick, this is not a conspiracy video. What I'm about to show you is from the Bureau of Economic Analysis's own announcement, and from Goldman Sachs and JPMorgan's own estimates. The numbers are public. I'm just going to connect them in the order nobody on the news will. And because the whole point of this story is that the official number isn't your number, I built an inflation impact calculator at timtalksfinance.com that shows what inflation does to your money in dollars, not percentages. I'll come back to it at the end, but it's there if you want to run your own numbers. Let's start with what just happened. Here's the setup. In late June, the Bureau of Economic Analysis, the BEA, the agency that produces the PCE price index, announced it's revising how it measures prices in three categories. PCE. That acronym matters because PCE isn't just any inflation number. It is the inflation number. It's the one the Federal Reserve officially targets. When the Fed says, we want inflation at 2%, they mean PCE. So the referee's scoreboard is getting recalibrated. Now, why should you care about a technical revision? 3 reasons, and each one gets bigger. Reason 1, the size. Goldman Sachs and JPMorgan both ran the numbers, and they estimate this change shaves about 0.2% off core PCE. May's reading was 3.4%. Under the new math, 3.2, maybe 3.3. That's not a rounding error. When the Fed's target is 2%, 0.2 is a meaningful chunk of the distance between inflation problem and mission accomplished. Reason 2, the direction. Notice the revision doesn't go both ways. Every estimate says the new methodology makes inflation look lower. Not more accurate in some neutral sense, lower. Reason 3, and this is the one that got me, it's retroactive. Back to 2021, the worst inflation stretch in 40 years, the years you paid it at the register, at the pump, on your lease renewal, gets officially marked down after the fact. Now here's the thing, when I dug into what they're actually changing, I expected to find something shady. What I found is more interesting than shady, because the change is technically defensible. And that's exactly why you need to understand the mechanism. Stay with me. So what are they actually changing? 3 categories: portfolio management and investment advice, computer software, and legal services. Let's take the big one, portfolio management fees, because this is the detail I promised you in the open, and it's the key to the whole story. Here's how it worked until now. When you pay a financial advisor, you usually pay a percentage of your assets. 1% of your portfolio, every year. So when the stock market rips higher, like it has, we just hit record highs, your advisor's fee, in dollars, goes up automatically. Same service, same advisor, same phone call twice a year, but more dollars. And the old methodology counted that as a price increase, as inflation. The Fed's own researchers flagged this. It ties the price of financial advice to the stock market. Markets boom, measured inflation goes up, even though nothing got more expensive in any real sense. So the BEA is fixing it. Software gets a similar treatment. They're switching to a blended index built from CPI and PPI data. Honestly, reasonable fix. If this had been announced in a random year, it'd be a footnote for economics nerds. But look at when it's landing. We're halfway through, and this is where it stops being a story about statistics and becomes a story about your money. Because the question isn't whether the fix is technically right. The question is what happens when the fix arrives at this exact moment and who benefits? Think about what's on the Fed's desk right now. The minutes from their last meeting, released July 8th, showed the committee split literally down the middle. Half of them want to raise rates before the end of the year. Half want to hold or cut. That's not a policy debate. That's a deadlock. Chair Warsh testifies to Congress this week defending their inflation fight. Consumer inflation expectations just hit a 3-year high. Regular people expect 3.7% next year, and CPI is still running near 4%. Now drop a methodology change into that deadlock. On September 30th, core PCE, the Fed's own scoreboard, mechanically falls 0.2 without a single price in the economy actually falling. So follow that thread with me, because this is where the money conclusion lives. Who wins when the scoreboard moves? Where does this actually land on you? 3 places. First up, rate policy. That deadlocked committee, the half that wants to hold or cut, just got a gift. Come October, they get to point at a 3.2% core PCE instead of 3.4% and say, see, we're closer to target than we thought. If that tips the Fed dovish toward lower rates, that flows straight into mortgage rates, savings account yields, and whether your cash keeps earning 5% or slides back toward 2. And notice the asymmetry. Your CD rate can fall because of a statistical revision, but your grocery bill doesn't get revised down with it. And if you want to see what that asymmetry does to your money over time, not the national average, yours, the inflation impact calculator at timtalksfinance.com takes your savings and shows you the purchasing power you lose by retirement in actual dollars. Whatever rate you think is real, 3.2, 3.4, or what your receipts say, plug it in and see. Links in the description. Second, the historical record. This is subtle, but it compounds. Wages, Social Security adjustments, union contracts, court settlements, a whole ecosystem of payments gets negotiated against, quote, official inflation. Every future negotiation now happens against a past that was officially milder than the one you lived. You felt 2022. You remember what eggs cost. The record will now politely disagree with your memory all the way back to 2021. Third, trust in the yardstick itself. And here's where I'll follow the evidence where it leads, like I always do on this channel. When the unit of measurement keeps getting redefined, CPI is already half estimated. We covered that a few weeks ago. And now PCE gets a makeover that happens to flatter the scorekeeper. Rational people start looking for yardsticks that can't be revised. That's the entire argument for hard assets. Gold doesn't get a methodology update. Bitcoin's supply schedule doesn't get revised retroactively to 2021. I'm not telling you to buy anything. I'm telling you this is why that money keeps flowing where it's flowing every time a story like this drops. Which brings us to what you actually do with this. And it starts with a date on your calendar. Remember the detail I promised at the start? The one category that tells you why this is happening now? Portfolio management fees. Think about what that category is. It's the price of managing wealth. The reason it distorted inflation upward is that asset prices, stocks, have been booming while regular prices were supposed to be cooling. The scoreboard was accidentally measuring the boom at the top and calling it inflation for everyone. So the fix is real. But understand what the fix admits. The market boom itself was leaking into the inflation number. Asset inflation and price inflation got tangled. And rather than untangle it loudly, the fix quietly subtracts it. The wealth effect stays. The measurement of it disappears. That's the real story. Not a conspiracy, an admission, filed as a technical note. So here's your signal calendar. 1. September 30th. The revised numbers drop. Watch how fast Fed officials start citing the new, lower core PCE in speeches. Count the days. That tells you whether this becomes ammunition in the rate fight. 2. The next FOMC meeting after the revision. If the cut camp suddenly grows, you'll know the scoreboard change did the persuading, not the economy. 3. Your own numbers. Keep your receipts. Literally. Your personal inflation rate, groceries, insurance, rent, is the one number nobody can revise. If the official rate falls 2/10 in September and your costs don't, you'll know exactly which number to trust. Here's the takeaway in one sentence. On September 30th, inflation gets redefined downward, retroactive to 2021. And while the fix is technically defensible, it hands a deadlocked Fed a lower scoreboard at the exact moment half of them are looking for a reason to declare progress. If this video connected dots for you, drop a comment. Tell me, do you trust the September numbers or your own receipts? I read every comment, and honestly, the comment section on these data videos is smarter than half of financial television. I've linked the BEA announcement, the Goldman and JPMorgan estimates, and the Fed minutes in the description. Check my work. That's how this channel operates. Follow the truth wherever it leads. And before you go, signal number 3 was trust your own numbers. Make it real. Run the inflation impact calculator at timtalksfinance.com with the official rate, then run it again with the rate your receipts tell you. 2 minutes. The gap between those two results is what this whole video was about, and no revision on September 30th changes it. Big week ahead. CPI drops Tuesday morning, and the new Fed chair testifies to Congress the same day at 10 a.m. I'll be breaking down what he says versus what the data says, the same day it happens. Subscribe so you don't miss it. I'll see you Tuesday.